all aboard. Here we combine our company knowledge, very good, with that of cash flow statements. The following information has been extracted from the records of All Aboard Limited that sells small boats and boating accessories across the country. The company maintains a gross profit percentage of 40% on sales. Well, I don't know whether we're going to use it, but let's color it in. The following information has been extracted for the year ended 30 September 2013. And it is obviously an extract from the statement of profit and loss and other comprehensive income. Gross profit, that's why they give it to me. They start with gross profit, so I must gross it up in order to derive at sales. So it's 40% on sales. So that divided by 40% will give you my sales figure. Other operating expenses, operating profit, profit on the sale of equipment, profit from operations is those two together. Financing activities, investment income, dividends, interest on mortgage bond, profit before tax, income tax, profit for the year, other comprehensive income, revaluation of land and buildings. Don't forget about that one. So we have to account for that also against our PPE accounts and total comprehensive income. Then the statement of financial position, non-current assets, PPE, investments. Now watch out for this investments. In many questions they do not say a word about investments, and clearly you can see that there was quite a change in investments in the current year. So part of investing activities will be a cash outflow, which is represented by that increase in investments. Inventory, debtors, cash and cash equivalents, share capital, quite a lot of changes, reserves, retained earnings, mortgage bond, also movement, creditors, income tax, shareholders for dividends and dividend withholding tax. Remember that we add those two together. Then additional information. Other operating expenses include depreciation on equipment and loss on scrapping of the equipment. Then they give us authorized share capital and issued share capital. Stated capital, that's ordinary capital, and preference shares. The original issue of ordinary shares were at R1.15 per share. Reserves consist of the following: share premium and revaluation reserve. Let's go back. So that reserves the revaluation reserve and share premium. It is the company's policy to declare dividends at the end of the financial year, with payment being made during the month of October in the following financial year. So strictly speaking, what should have happened then is that the previous year's dividends should have been paid in October of the current financial year, and the current year's dividends will probably only be paid in October next year. So if we look at shareholders for dividends, where are you? That should then be our dividends which we declared at the end of the year, which hasn't been paid. Although that amount there, the opening balance, should have been paid. Immediately after the dividends were declared, the company bought back 100,000 non-cumulative preference shares at a price of R2.80 a share. So that would be part of financing activities. This was partially financed by the issue of 200,000 ordinary shares. So there was also issue of shares at R1.25 each. An additional issue of ordinary shares was made during the year at the same price to help finance the purchase of land and buildings, which were purchased to expand operations. So land and buildings, obviously there was an acquisition, and that was for expansion purposes. Then the carry values of property, plant and equipment, land and buildings and equipment, we have to reconstruct obviously this whole, all those accounts. Land and buildings were revalued for the first time during the current financial year, and we've already picked up the revaluation reserve, which was 850,000. Equipment with a cost price of 80,000 and accumulated depreciation of 62,000 was sold during the year and replaced with new equipment. Equipment with a book value of 16,000 was scrapped during the financial year. So some equipment was replaced, sold, bought, sold, and scrapped. Okay. Prepare the statement of cash flow for the year ended 30 September 2013 using the direct method. Very important. Cash received from customers and cash paid to suppliers and employees must be calculated separately and may not be calculated as a balancing figure. So you must give them exactly how did you derive item by item at those two figures. And then you also have to prepare the note to reconcile profit before tax to cash generated from operating activities. Great. So let's start our answer by writing down basically our framework for our statement of cash flow. And then after we've done that, let's start with property, plant and equipment. Property, plant and equipment. And they give us then the breakdown of property, plant and equipment. So let's open up T accounts for that, for land and buildings as well as for equipment. Opening balance, closing balance, opening balance and closing balance. Land and buildings, opening balance 1.8 million, closing balance 3 million. Equipment at carry value. Why at carry value? Because that is all we have. They only gave us the carry values of property, plant and equipment. So carry value, opening balance 700, that one there, 820,000 and closing balance 782,000. Now if they only give you carry values, then you have a combined account for cost and accumulated depreciation. And it's not an issue. What you would have posted on the debit side of those two accounts, you're still going to post, but you only have one account for it. And those transactions that you would have recorded in those two accounts, i.e. the cost account and the accumulated depreciation account, you're still going to account for on the credit side. The only difference is you're going to do it in one account. Okay. So let's start then. We have the opening balance and then we have the closing balance, 782,000. The tenants, land and buildings were revalued for the first time during the current financial year. Now, we have already picked up that our revaluation surplus for the year was 850,000. So in our land and buildings account, we can insert revaluation 850,000. Nothing further happened. There was no land and buildings sold for the year. So therefore, we can actually balance off this account and see that we have acquired new land and buildings of 350,000 rand. So that new buildings, that would definitely be for expansion purposes. We haven't sold anything, so we couldn't have replaced something. In order to replace something, you must have had something to replace in the first place. We didn't sell anything, but we've added once we've worked out our balancing figure. So immediately after you work that out, you can go to investing activities. Cash flow from investing activities, purchase of land for expansion purposes, 350,000 rand. Cash outflow because we have bought land. Great, now we can do the equipment. We say that equipment with a cost price of 80,000 and accumulated depreciation of 62,000 was sold and replaced with new equipment. Now guys, you can do it either the long way or you can do it the short way. Remember, we work with carrying values, so therefore we work with net values. So you could only have taken out the carry value of this equipment, which is 18,000, out of the equipment account, or you could have done the two separately. So equipment. Well, if I've taken it out separately, if I took out the cost price, like I would normally take out the cost price out of the cost account. So on the credit side, I took out the cost price and I put it into the asset disposal account. Normally, what will we do when we remove accumulated depreciation? We debit the accumulated depreciation account. Now we're going to debit the carrying value account. So we're going to debit that, 62,000. We're going to credit our accumulated depreciation of 62,000. Somewhere along the line, they gave us the profit there was a loss on the scrapping. I haven't done the scrapping as yet. In our income statement, profit on the sale of equipment, there it is, 12,000 Rand. Profit on the sale of equipment, 12,000 Rand. So in our asset disposal account, we have the 12,000 Rand. So now, therefore, we can go and determine the proceeds on the sale of the assets. That is the balancing figure in our asset disposal account. Once we have the proceeds, we can go back to our cash flow statement, cash flow from investing activities, proceeds from the sale of machinery, 30,000 Rand. So you park it immediately and then you can forget about that. Good. They also told us that some equipment was scrapped during the year. Equipment with a book value of 16,000 Rand was scrapped during the year. Nowhere here in our additional information, they gave us an amount that we have received for scrap metal or something to that effect. So basically what will happen is that the total book value of these assets that has been scrapped, that will then equal a loss on the scrapping of that asset. Just see whether it has been indicated here somewhere. No, that isn't there. And then there with a loss on the scrapping of equipment, 16,000 Rand. So once we go back to our T accounts, we will have an asset scrapped account. It's the same thing as an asset disposal account. And out of our carrying value account, we would have transferred the book value of the asset scrap, 16,000, to the asset scrap account. And then we would have made a loss on the scrapping of 16,000, which is exactly that 16,000 that I've just shown you over there. Great. Now, if we actually, depreciation, they gave us the depreciation figure. Depreciation on equipment, 164,000 Rand. So in our accumulated depreciation account, we would have credited it with 164,000. We only have one account now, so we're still going to credit this only one account that we have. Depreciation for the year, 164,000 Rand. Now we can work out the balancing figure, and the balancing figure in our equipment account is going to be 160,000, and they've told us that there was some equipment purchased for replacement purposes. So now when we go back to our cash flow statement under investment activities, new equipment for replacement, oopsie, there it is, replacement purposes, you can insert in the cash outflow of 160,000 Rand. So it seems to me that we have finished off our PPE section. What we are still going to use is non-cash flow items, depreciation, profit on disposal, and loss on the scrapping of the assets. And that we're going to use when we get to items that does not represent cash flow. Good. So let's start then our cash flow statement by determining our cash received from customers. Now, when we read through the question, we already identified that they didn't give us any sales figures, but they gave us the gross profit figure. So they gave us gross profit is 40% on sales. So obviously we can work back to our sales figure. So 2.4 million, 40% of sales. So therefore our sales figure was 6 million. There's absolutely nothing in this question that is happening in any debtors account. So therefore, we can take our sales figure and just look at the movement in our debtors, outstanding debtors on a year-to-year basis. So if we go to current assets, it is debtors. It has increased from 675,000 to 825,000 Rand. So there was an increase in debtors. Increase in debtors represents a cash outflow. So therefore, we're going to take the cash outflow of 150,000. So cash received from customers, 5,850,000. And you can go to your cash flow statement and you can insert that amount of 5,850,000. Just coming back here, I've actually dotted down a number of things that you should watch out for. Watch out for entries in debtors accounts that does not represent a cash flow, such as credit losses written off. Then you have to make an adjustment, and then I would suggest that you use a T account. Closing balance, opening balance, credit sales, bank, credit losses written off. If I give you not the gross debtors amount, but I give you the amount which was displayed or disclosed in the statement of financial position after in other words, I give you the net trade debtors figure after the allowance for credit losses has already been deducted. Then you should know when you want to work out cash flow from debtors that you have to add back the allowance figure in order to derive at your actual debtors control balances. Remember, you cannot work with net figures. You cannot work with a figure after the allowance for credit losses have been deducted. You have to work with a gross figure before any deductions was made for statement purposes. And then I say, well, if there's something like settlement discounts, RD checks, all those nice things that we've done in the first semester, rather do the T account and work towards your bank figure at the end of the day. Great. Now, the third thing that we want to work out is cash paid to suppliers and employees. And our starting point there is our profit before tax. So profit before tax is what? They gave it to us. They said to us, profit before tax, 736,000. So we can do it either in a T account format or in a statement format. The choice is yours. But the starting point is profit before tax, 730,000, 736,000. Now, what do we have to account for against this one? We want to work out expenses converted into cash. That is what this is all about. Now, expenses converted into cash says take out revenue. It's got nothing to do with expenses. And we've worked out revenue here as 6 million rand. Sales, in other words. Sales, 6 million rand. Then we want to add back non-cash flow items. And we've already identified depreciation of 164,000, profit on the disposal of equipment of 12,000, and loss on the scrapping of equipment of 16,000. So let's put it in. Depreciation, loss, and remember profit is on the credit side, profits. Depreciation, scrapping loss, and then profit on the disposal of 12,000. Here I've taken out revenue 6 million as well, same as what I've done there, because that we have used with cash received. It's got absolutely nothing to do with expenses. We want to convert expenses now into a cash figure. Great, if we go back to the income statement, you will see in the income statement that we have investment income. Now we know that that's a separately item that I have to show separately, so therefore I have to take that out of my profit figure because it's got absolutely nothing to do with expenses and it is a separately disclosable item. Interest on the mortgage bond, again, this is a separately disclosable item, so I want to take that out of my profit figure as well. So coming back here, I'm going to take interest paid out, 164,000. Dividends received, I'm going to take out of 68,000. Dividends received, it's an income, now therefore it's on the credit side of the P&L account. Profit is an income, therefore it's on the credit side. Interest paid is an expense on the debit side, 164,000. Good. Then I have derived at my other expenses. So the expenses that I have accounted for in my income statement which is all cash flow related expenses, or it is not an expense that I have to show separately. So now what we want to do is we want to convert that other expenses of 5 million rand. You can see clearly there it's the same figure in both, 5 million there and 5 million there. I will start off with that 5 million expense. And now I'm going to account or adjust it for the accrual basis. Where do I go to first? It's expenses, so inventory. What happened to my inventory figure? Inventories has decreased in the current year of 2685. Watch out for inventory though, because if there are non-cash flow items included in inventory, like what for instance? Inventory write-downs, inventory losses, net realizable value adjustments, I have to make an adjustment for that because it's a non-cash flow item. In this case, it's just a movement. It is a decrease in inventory of 65,000, so that will represent an increase in cash. Then our creditors figure. Here, creditors, there was a decrease in creditors as well, so that's an outflow of cash. I've paid them more than the finance that I received from them. So there's a decrease of creditors, 75,000, cash paid to suppliers and employees, then 5,010,000. And I can go and plot that on my statement of cash flow, 5,010,000. I do calculate then the net cash generated by operations of 840,000. And now I have to write my reconciliation note. Now guys, my reconciliation note is basically my amounts paid to employees and suppliers. I just have to twiggle that calculation a bit. Where am I going to start? I'm also going to start with my profit before tax. So start with my profit before tax of 736,000. What I'm not going to do is I will not take out revenue. Why not? Because I need that figure in because I'm working now with a third line. And therefore that line is included in that line, so I cannot take revenue out anymore. So revenue I leave. However, I'm still going to do items that I'm going to disclose separately and non-cash flow items. So all these other items, the 164, the depreciation, the scrapping loss, the dividends received, and the profit on disposal, all of them will appear here. Just for non-cash flow, depreciation, loss on the scrapping of machine, profit on the sale of equipment, separately disclosable items, dividends received and interest paid. So exactly the same as in the other one. Now here, when we actually adjusted it for accruals, we only had inventory and creditors, but remember, I work on the third line item, so I also have to take the movement of debtors into account. So the first thing that I'm going to do is I'm going to take that increase in debtors as well as the decrease in inventory and the decrease in creditors, and I'm going to plot that as total movements in working capital. Inventory, debtors, creditors. And then when I do all those adjustments, voila, I'm back at the 840,000 Rand, which equals then my cash from operating activities. There's also activities. Okay. Good. Now the separately disclosable items. Dividends received. Dividends received, I have it in my income statement of 68,000. Finance cost, interest on the mortgage bond, 164,000 Rand. Interest paid, 164,000 Rand. Now the only other two is there was no interest received. We have to show dividends paid and we have to show tax paid. But for that we're going to reconstruct our accounts. Let's do the tax first. SARS. What was the outstanding balances on the SARS account at the beginning of the year? SARS income tax, opening balance 92,000, Closing balance 61,000. 92,000, 61,000. What was my tax charge for the year? Where do I get that? I get that in the income statement. So our income tax charge for the year was 187,040. 187,040. And that I'm going to transfer into that account. And then I simply just balance off the account to get the amount actually paid to SARS for the year, which equals 218,040. So here, tax paid, 218,040, and that is in brackets. Now our shareholders for dividends, because we have to show dividends paid. If you go to our statement of financial position, you will see there that we have shareholders for dividends and dividends withholding tax. So our opening balance would have been those two together, and our closing balance would have been those two together. So let's have a look in our T account. Opening balance, the two of them, you can either add them together or show them separately. I don't care as long as both of them are actually appearing there. And now the dividends declared for the year. Guys, in this question again, like in the previous example, they didn't give us the total dividends which was declared. We know that there were dividends that was declared, but we don't know what the amounts were. Now again, what we're going to do is exactly the same as in my last chance. We're going to use retained earnings. So we will have an opening balance of retained earnings. We're going to increase that with my profit after tax for the year. Profit after tax for the year of 548,960. We're going to reduce it with the dividends, which is X, and it's going to close off with our closing balance of retained earnings of 1,565,960. Start with the opening balance, take our profit after tax. That is our closing balance. So the balancing figure must be our dividends declared for the year, 480,000. So our debit our retained earnings and credit shareholders for dividends, 480,000. And then we can just balance off this account, and the balancing figure on the debit side will be the amount we actually paid for dividends in the year, 410,000. So dividends paid, 410,000. Now we can work our cash flow from operating activities, 115,960. Cash flow from investing activities. Now remember that investment story that I've told you. I've told you that you must watch out for investments. There I've colored it in. So there was an increase, so that was an outflow. Nowhere else in the question they mention investments at all. So I call that the silent partner. So there was an outflow, increase of investments of 314,400. Going back here, there we have actually said that we have acquired new land and buildings of 350,000, and we have also acquired equipment of 160,000, and we have, as a matter of fact, already put it down here. Proceeds from the sale of machinery we've also done. So that portion we've already completed. Now cash flow from financing activities. If we go to our mortgage bond, they do not say anything about the mortgage bond again, so there's clearly an increase in the mortgage bond, so we receive more finance out of the mortgage bond. Yeah, and that is a 550,000 cash inflow. Issue of ordinary shares. Now, they only give us share capital, and here somewhere they've told us issued share capital consisted of stated capital and preference shares. So clearly there was an additional issue of shares. And they also told you what was the original shares issued for. But clearly if you just look at those balances, you can see what was the increase of the shares. 1.6 million minus 1150 increase. Now here somewhere they've told us that they bought back 100,000 non-cumulative preference shares at R2.80 each. So what was the cash outflow? 100,000 times R2.80 equals 280,000 rand. And then the only remaining thing is our movement in our cash and cash equivalents. So if you're going to look here in your balance sheet, cash and cash equivalents has increased from 29,000 to 70,560 rand. 29 to 70 gives us 41,516. So now if we take our cash flow from operating activities minus our cash flow from investing activities, because that is an outflow of cash, plus our cash inflow from finance activities, if I add those three figures together, you will see that you're going to come back to our net increase or decrease in cash for the year.